Hello, everyone. On behalf of the Councilors of Real Estate, welcome to this presentation of 2025 is here. Now what? Featuring members of our esteemed Economic Advisory Council. Thank you for joining us. I'm John Henschel, CRE Global Chair of the Councilors of Real Estate and President of Henschel Real Estate Services in Abingdon, Maryland. The Councilors of Real Estate is a distinguished solutions-based consortium of accomplished advisors addressing real estate challenges worldwide. Experienced, innovative, principled, and credentialed problem solvers, counselors reside in 22 countries, practice in many more, and offer expertise in 60 real estate disciplines across all asset classes. Each has earned the prestigious CRE designation, a badge of distinction that represents a commitment to excellence. Before we begin, I'd like to offer you a free digital subscription to Real Estate Issues, our peer-reviewed global professional journal, recognized as one of the top 10 essential real estate publications in the United States. You can subscribe by visiting cre.org/REI. Let's recognize our sponsors that have supported us over the past year: Husak Real Estate, Equus Capital Partners, J.P. Wigan and Sons, McCurdy, Riskin, Olson and Delapel, and WPJ McCarthy and Company. Thank you to all those for your partnership with CRE. You're encouraged to utilize the Q&A feature should you wish to submit a question. Your participation is welcomed, and we'll answer as many questions as time allows. I'd like to introduce today's moderator, Joshua Harris, PhD, CRE, Executive Director of Fordham Real Estate Institute in New York, and Chair of the Councilors Economic Advisory Council. Dr. Harris also is managing partner with the Lakemont Group, a boutique real estate and economic consultancy based in Orlando, Florida. He has held prior academic positions at New York University, St. John's University, and the University of Central Florida. Prior to joining Fordham, he was Vice President of Investment Strategy for Skanska USA Commercial Development. Dr. Harris was invited to membership in the Councilors of Real Estate in 2015. Today's conversation promises to be informative, enlightening, and as always, will be entertaining. Welcome, Josh.
John, thank you so much, and thank you to the counselors for organizing this and everyone who's to attend. Well, here we are. It is now 2025. I feel like this has been a very anticipated year since, I don't know, maybe in 23 when we were coming up to the reality that interest rates and the Federal Reserve policy was likely going to be extensive. And who out there probably heard of that? Survive until 25. I feel like that mantra started at very early part of 24, maybe in 23. Well, it's now 25. If you're here, you've hopefully survived far. Whether we are in the place that it is meant to be. Oh, I love this question that they have just popped up here. So what is the, we'll talk about this when we get the see the results, but we're here and now we're going to get to talk about what is going on. So my first question to the very esteemed panel here is interest rates. I think this is the thing that's on a lot of people's minds. I know we had a little bit of CPI data. I believe it was morning, some inflation data. Where do you think interest rates are going to go? Is this what we expected? And really, what are the implications for CRE assets and valuation at a 10-year treasury that's worth a 4 or 5, or at least certainly was yesterday. So we'll start with Elaine, and everyone just kind of introduce yourself as you go. I'll start with we'll go to Elaine, Doug, and Dennis, just following that order. Elaine, take it away.
Great. Well, thank you, everybody. I really appreciate being here and being invited to be part of this prestigious panel. If you don't know, I'm from Clemson University, and I've been working in the real estate industry, particularly primarily as an academic, but I work a lot with the commercial side, particularly the institutional investment side. And, that's a really good question, Josh, and we're all kind of wondering. Some of us are scratching our heads, but others are saying no. It makes some sense that the interest rates, particularly for long-term investments, particularly a real estate investment, they're not coming down very quickly. And somewhat in my mind, they probably won't, because again, interest rates represent risk. And something you'll hear me say probably more than once on this call or webinar is that there's still a lot of risk out there for real estate investments. It's not all real estate investments. It's not everywhere. But there's a lot of properties that are not, doing the greatest. And again, investments in real estate are risky. And if you're borrowing money, not surprised the banks recognize it as well. They're sitting on a lot of potential time bombs. And so, yeah, to me, it makes sense that we probably won't see real estate interest rates on mortgages, primarily commercial real estate mortgages, come down anytime soon because there's just risk associated with current market conditions.
All right, Doug?
Yeah, I'll just jump in. I'm Doug Putas. I've been around a very long time, and I'm going to start by showing you how long, which was I entered the economic forecasting industry on January 3rd, 1980. And so I go back, Mike's been transitioned over to real estate by the end of the 80s. So my experience goes back to the last time that I think is in some way parallel to where we are. And that was the 1970s. We'd come off a period of extraordinarily low interest rates and very strong economic growth in the 1960s and into the early 70s. And we didn't really think much about inflation. And then we got a little bump up, and President Nixon put on price controls when inflation was still less than 3%. And we came through and we had a little recession downturn. The Fed raised rates. We had a little downturn in the mid 70s. And the Fed didn't want to have a full recession. So they kind of cut fairly early and brought rates down, and the economy had a decent run. The stock market was up, 23%, 35% in 75, 23% in 76. And then it muddled along. And then 1979 happened and 1980 happened. And Paul Volcker had to crash the economy in order to get that inflation back out. Now, I'm going to say, I've been saying this now for 2 or 3 years. That's the risk the Fed is running. And our current 10-year Treasury rate is a 10-year rate we haven't had sustained in this economy since 06 and 07. 4 or 5 is not a high interest rate by historic standards in the United States, but we haven't sustained a rate above 5 since 06 and 07. So I think people really have to think about the risks that we have stuck ourselves in an inflation cycle, and the government seems to be getting even more expansionary in their fiscal policy. The last one was very expansionary. I think the incoming one is going to be very expansionary in fiscal policy, different direction, rate, tax cuts instead of spending increases, still both expansionary. So I think the Fed really has their job cut out for them.
It's an interesting point. I think as I looked at the CPI release, it was actually up a 0.4, and just pulling the little chart, I realized like it's actually trending up. The market reacted like incredibly excited today's, which means that they really expect worse expectations. So take that for what it's worth. Which Dennis,
I was shocked by the market reaction, and until I did one other thing, the stock market reaction. Everybody on CNBC and other things, they always described what happens in the U.S. stock market to some piece of news in the U.S. Germany was up 1.7% this morning before the U.S. news came out or the U.S. stock market opened. So I don't think Germany went up because the U.S. CPI was great news.
Actually, Dennis, you might be the perfect person who is currently in the wonderful continent that is Europe. And it's what you think about this, certainly, and give us that perspective. Obviously, we're maybe a little U.S. centric here, but what's your view on inflation, both for the continent U.S. as well as Europe, and how that could affect capital and everything else?
Yeah, well, thank you for that question, Joshua. And Doug, when you started with economic forecasting, I wasn't even born yet. My name is Dennis Schoenmaker, and I lead CBRE's global forecasting platform, which for the US audience, Econometric Advisors is part of, but we also have Europe and Asian Pacific teams that produce forward-looking views, leveraging our macroeconomic house view and translating that to the real estate market. I think it's very unique times, as Elena and Doc already talked about the U.S. market. I think translating the US, what we see in Europe, I think a couple of interesting things, especially on the bond market. If you look at the UK bond market, has responded quite similarly to what we've seen in the US. Market expectations for cut rates are quite similar. Like I think we've all seen, especially after last week's jobs report in the US, that market expectations have quite come down. I think consensus in the US is around 2 cuts. We even seen some of the banks saying that the potential next move is going to be upwards. I just think that there's a lot of uncertainty and volatility in bond yields. Like if you look back at last year, at one point we were around 3.5, 3.6. We're now up high 4s. I just think that we need to understand like what is noise and what is the trends and where are we going. If I take the story back to Europe, Europe has quite a challenging environment. I think the geopolitical environment is quite difficult. We've had, I think, one of my colleagues mentioned this to me. We had 70% of the free world had elections over the last 12 to 18 months. And I think almost all of these elections, and please don't pin me on this one, have flipped. So this just shows the challenging environments that we're living in. And due to those environments, I think bond rates have increased due to the risk element, especially around inflation expectations, which have also impacted UK bond yields quite a bit. So I would just say it's a very uncertain time. The market has been more optimistic last year. I think this year we move into a more cautiously optimistic environment. I can come back later to what this means for real estate, but we still feel that like the ECB will keep cutting interest rates. I think for the ones that seen Germany's GDP coming out this morning, it showed another contraction. I think it was minus 0.2% for the year. France has
Germany is part of the headline I saw.
I think it's 2 in a row from the headline that I saw. And I think France has its own issues stemming from political issues there as well. The UK, of course, had the budget where the response was quite mixed, not as bad as during the Liz Truss era a couple of years ago, but again, very challenging environment. But due to the fact that we're entering a new cycle for real estate, there are definitely opportunities that I would like to talk about today.
Mm-hmm. That's great, Dennis. So I'm going to stick with you. Well, actually, we got our poll results here for the first
There we go.
And it looks like fixed in 26, a slight winner over Thrive in 25, but Heaven in 27 is far down. So it's interesting. There was not a clear winner there, which I think it might be good.
A lot of people didn't vote. So that must mean they're held out till 28. Look at that.
Yeah, it's like the time.
166 people in the room, and we only got 61 to respond. This is terrible. These guys are live and they're not responding.
Maybe when we were joking about this on our prep call, we'll be fine in 29. Maybe that's the feeling now. But
I think celebrating 28.
There we go. I'm going to stick with you just to lead the next one, and specifically with that kind of a background of obviously Europe being softer from an economic perspective. Has been true, and obviously there's more direct impact from the Ukraine war and things like that. But and just probably lower base rate growth in general. Do you believe both European investors, and you can broaden that to global investors, is there likely to be more Is the U.S. going to receive more cross-border inbound real estate investment class, or where do you think the cross-border flows are going to come in as a result of that kind of differential?
I think, as I mentioned, like the mood in 24 was quite promising, finishing off the year. If you look at some of the numbers that have been coming out, they show quite a good growth in investment activity throughout 2024. 2024, especially Q4, based on some preliminary data that I've seen, for example, from RCA, has shown that. In 2025, I think, as I mentioned, we're a bit more cautiously optimistic. I have heard that a lot of people, of course, have money to deploy, but they're very particular in where they want to go. We've heard from talking with some of the clients that there is appetite for European and Asian Pacific investors to move to the US. It's a lot about like what's the right product that is available. I would also say that within Europe, there is quite a lot of opportunities as well. Like, for example, in the markets that have repriced a bit more, given a higher interest rate environment. I especially look at the UK. At London is attracting quite some capital as well. And I'm just more of the view that this cycle is quite different. It's more like an income cycle. So it's really again about the location, and asset-specific underwriting and understanding the risk of that asset. So that's what we're seeing. But overall, I think the market will see higher investment volumes in 2025, but we won't go through the roof, so to say. I think we will see a recovery that is a bit slower than we probably previously anticipated, but I still expect there is some growth. And what I think from the discussions I've heard also with some of the lending parts of the industry is that we might see some more motivated sellers coming to the markets in 2025. Some of the extent and percent might be need to solve as well. So all that together, and the uncertainty in the bond market, which I think we all agree on, it's going to be a challenging year, but I think we're going to do better than 2024.
Well, and I think that's a great place, Dennis, and I'm going to then tee up Doug and Elaine to respond to this a little bit. Is that a lot of stuff I think was towards the end. We don't know. Sometimes this December of the year always surprises with transaction activity. Some of the definitive like real app analytics doesn't come out maybe for another week. How good 24 actually was or not. But I'm not expecting a lot out of that prior quarter, given just the interest rate up shock that happened rather than a down shock that I think some had forecast. So Doug and then Elaine, I guess the question now is, who do you think will be buyers and sellers in 25? Do you think this will be better than 24? And Dennis threw that tend and extend, which obviously motivate transaction volume or loan volume. How do you think? What's volume? So I guess the question is, we'll go Doug then Elaine. What's volume? We'll be like, who are the buyers and who are the sellers in 25?
Well, I'll jump in. I think a big piece of it is on the asset allocator front. We've just come off 2 straight years of S&P 500 over 20, and the German equities market is at an all-time record high, and so people who are asset allocators need to put money out into real estate because, at least in the US, they've finally written stuff down a little bit. The lag came right back into our market. The lag in write-downs. I mostly invest. Most of my investment activity now is for European. Tristan, my European partner, and in the UK, prices cleared and things were trading. There wasn't high volumes, but prices cleared because the valuers wrote them down. In the US, they're still stuck there. Was glad to see overnight somebody got, I don't get it, but the early release on Odyssey was slight appreciation in the fourth quarter. That's a really good sign, right? That means that maybe after all those quarters of slowly writing stuff down, it's finally down there. But you need a willing seller and a willing buyer.
Can I ask you? You can speculate if you don't know the answer, but if Odyssey is going to show a print of a positive appreciation, do you do essentially that they both in earnings or means that change in the multiplier, or is that due to the actual performance of the assets? Do you have any sense?
I got something that was a digested version of a print sent to somebody else. It's the initial print just came out last night. It never has that backup information in it. It is just what the return was. But Yeah, I just think that the asset allocators need more real estate just because the stock market has run. But I
Yeah.
just wanted, one of my main points is the history of what happens after 2 straight years of 20+% S&P 500 returns. It depends on whether you're doing price return or total return. This was price return was over 20%. There have been more cases of total return. And a couple of those cases of total return over 20 turned out okay. But the prior times that we had 2 straight periods of price return over 20, 97, 98, 2000, 2001, 2002, really not good times in the stock market. 1935 and 1936, 37, 38, 39, 40, terrible times in the stock market. 1927, 1928. This one shocked me, by the way. 1929 was really not that bad a year in the stock market. Total return was only -8. We all think the Great Depression started in 1929. It really started in 1930, 31. So there really aren't that. The only other case is the 1950s, 54, 55. And 1957 was -10. 1956 was okay. However, people who think that it's a great time because the stock market's had 2 20% years, the stock market is always forward-looking. It's forward-looking, but never look back at.
Well, we call me. So anybody who needs a good way to sell investment real estate, Doug has got tracking for that. And if you want to trim the sales or portfolio, we don't give stock advice here, so we'll leave it to somebody else. But Elaine, go ahead.
Yeah, good point. Good point. Although everybody need to remember that stock market, there's some major companies driving some of that return.
In all seriousness, why people get shocked by mean reversion always surprises me. It's one of the most
me too.
truths in long-term statistical analysis. But Elaine, go. I'd love to know your view.
All right. Well, Doug, you are impressive with all your stats. I don't have any stats for you. I'm not on the hot wire for NCRE, so I apologize on that. But my gut, and again, it's just a gut, and again, it's going to be property specific. One of my messages is risk, and the other is fundamentals. And you've got to pay attention to the actual asset, the actual specific building. And nobody is buying the empty buildings right now unless they can get them dirt cheap. Why? Because they got to get filled up, and it's expensive to fill them up, and they may not fill up. So it's really, I think Dennis mentioned it, and it's going to be a block and tackle thing here right now. It is not for the faint of heart. Again, if you're buying a building that's fully leased with wonderful tenants in it, Doug was talking on our prep call about buying. He'll buy with cash if it's got a good long-term lease on it that with a good tenant that he feels good about, and he can tell you about that later. But again, if you got that, you'll buy. If you are a owner and you're sitting there and you've got leases coming due and there's chances that those tenants are reducing their space and etc., then you're sitting, shaking, waiting, and hoping if you have a loan and that loan's coming due too, and you're in a CMBS, and that CMBS is knocking on the door, you're shaking in your boots trying to figure out, do I need to call the guys over there at CBRE and have them work distressed loan for me? It all depends. It 100%. And this is going to be so important. And it's not location. It's that actual building. How is that building sit in the market? Where is it in its leases? Where is it in its linkages, and how it's tied to everything else? Does that market have the things that people really want and to be in a community or not? I mean, it's going to be very much. And these asset allocators, I know they work on these big models and they look at these big picture, but you really are going to have to get down and dirty, and it's granular data you're going to have to understand those properties and the values of them. And it's great to have this big data out there, but it also makes it much more complicated because it's hard to parse it down and actually get a sense. So to be honest, I'm really glad I'm actually in the academy. So I don't have to do the block and tackle. In addition, I'm about to maybe, in a while, what do we say? Heaven in 27? No. Yeah, maybe celebrate in 28. I might be retiring. So there you go. And then I can be like, dog, and I have more time to look some cool stuff up because I loved the history lesson we just got. Because again, my mom's a historian, was a historian, and history does sometimes repeat itself. And it was interesting, Doug picked 70s. I still think mid to late 80s and early 90s is kind of where we're sitting. And that's where I kind of got my start. I graduated in 86 with my master's and became a valuation professional in San Francisco when the Reef, the Rosenberg Real Estate Equity Fund, finally, and I didn't make the paper, but Wall Street Journal had a little thing, they used to have, for those of you that are older, we had one little column on Thursdays in the Wall Street Journal that focused on commercial real estate. And Reef was the first major institutional investor to write down assets. They did it in Texas and Colorado, but that was it. And I was a little appraiser, 26 years old, and I was doing the Rosenberg Fund in Milwaukee, and they were losing a major tenant. I wrote them down, and my boss didn't want me to write it down, and I ended up quitting. I was a doctoral student at the time, so I was ready to quit. But you know, I started getting pressure. And that's what's happening out there right now, and it's very much how our industry works, but it makes it really hard to understand it and read it and make investments.
Those are great points. I think, one of the things that I've noticed this a lot in my own kind of consulting and deal side practice, that, the weeds of doing deals and getting into the individual asset is so important. And I'm working a lot on retail real estate projects and even looking at and working on what could be some mall redevelopments and interesting things. And they always say the devil's in the details. I mean, in the level of understanding cost and leasing. And by the way, I'll say this, and I've pretty loud. I think there's huge opportunity within retail in particular, just because was so beat down in the last cycle and therefore so underbuilt on a relative basis. But I'm seeing that I'm not going to say this is going to cause any huge disruption in of itself in 25, but I do think it's going to have to start to be played out. Inflation has been very real in the OpEx and CapEx of assets. And I've still seen a lot of, be it developer pro formas or just even asset management plans that, I love, we use the phrase allocators, the institutional asset managers, which are increasingly, and I think some of us in academia can even be faulted in that, we've separated where people came as property managers or agents before they went to become portfolio managers or acquisitions people to be more, they come from finance. That, I mean, these ground level changes I think are more significant. And, we obviously insurance, I think, this horrible things that have happening in California. We had a round of hurricanes and all in a matter of months, really. And it's not just that insurance costs go up. Insurance costs are going up because the cost to rebuild has gone up because materials and labor has gone up, and the cost of, because labor is higher, the cost of that doorman, the maintenance crew, it all cycles, right? And I think that I'm not sure that our industry has honestly done a great job of maybe capturing that impact on NOI that CapEx and OpEx has to inflation. So I do, I think there's going to be buying opportunities, because I do think there's going to be some kind of force to market transactions. But I do think that we have to be, we're all talking about interest rates, and I mean, that's a debate to itself. But commercial real estate is an income producing asset, and you have to have, I think people take NOI for granted way too.
They do.
And my apartment friends who we need a lot more housing. It's like the long-term shortage of housing is very real, but I've seen pro formas that get done and price on apartment deals that just make me like, wow, I'm impressed. But I hope it works out for them, is kind of how I feel sometimes. So I kept through out a little bit from an airball reaction, just this inflation. And again, inflation, I think maybe this even came up with the election a little bit. Like, inflation is not just some blips of a CPI number that if you even know that, it's the Bureau of Labor Statistics that produces them. I mean, it's real dollars and cents into people's personal financial budgets, and certainly operating budgets of companies, and operating budgets for properties. How do people? I'm going to just throw it out. I don't know, Dennis or Doug, if whoever wants to go first on that. But I want all your actions. Like, are we going to see inflation maybe continue to be a real factor in how we operate and look at properties this year?
Well, personally, I think, and again, I'm going to go back to that income statement that you're talking about, Josh, and it is so important to understand that that NOI moves regularly. And, somebody buys an asset, but then somebody else has to manage that asset and figure out how to keep that NOI where it's supposed to be, or you won't get your returns. And right now, particularly again with insurance, you are, I think, 100% right. Insurance rates should be modeled much higher, will be going up. Personal insurance, but also the commercial building insurance. So everybody's being impacted. I personally have had a huge rise in my home insurance, as well as, if you have investments, you're going to have that. And then in addition, I think property taxes, again, this fire, I am just amazed and a little bit appalled. But I kind of, when I started thinking about it, I was debating with John Bazuski, who's one of another CRE this morning. And California had Prop 13. California in 1973 kind of locked in their property taxes. Yeah, property taxes are what pays for all this services to fight fires and fight crime and fight, and be part of create a community. And, those budgets apparently, again, I don't know, haven't done the research. They will be researching it, I'm sure, and coming out, but it seemed like, there wasn't a funding issue. And all of our cities are having funding issue problems, and are all of our municipalities. And so I can't help but think that they're going to have to figure out a way to raise that money. And guess what? It's oftentimes property taxes, and real estate is already, the NOI is already being squished. It's something that can change every year, right? And you have no control really, your real estate tax bill. So I think investors need to be, thinking about that one too, and thinking about ways to try to, if possible, bring it down. But I talked to one of the assessors here in South Carolina, and she said, everybody's taxes are going, or values are going up 40%. So what does that say about your taxes? They're going to go up too.
Go ahead, Dennis.
So just to add there, like if we believe like we're in like this new environment, this new cycle, where this cycle is going to be more about like income producing to deliver total returns, and with that, we are going to be much more focused on NOI growth. I think we also believe that real estate is much more operational than it has ever been. So the focus on these cost elements will be super important for asset management, which I think, by the way, is the way to lead alpha or outperformance compared to the benchmark in this current cycle. We need to be completely focused on all those costs that you just mentioned, but also on the CapEx side. Like, I think there was one question that I saw, like about like climate risk, etc. Like, what do I need to invest in my building to keep it up to date, that I ensure that when I have a lease renewal, that the tenant wants to renew because their views are aligned with how the property is being operated, or to attract a new tenant. But also, when you need to sell, do I still have a liquidity pool? So it's not only OpEx. I think we should also be focused on CapEx in this particular cycle. And again, in the current environment, climate is maybe going a little bit to the back of the agenda. But I always say, like, climate is the long game. Like, if I look at 3 residual cap rates, I'm already in 2050. And I think this needs to be part of how we look at the market. And we do that a lot in Europe. Like, I think in Europe, it's part of the investment committee memo that there needs to be some kind of information around, like, okay, what do we think about physical and transition risk that we might have if we invest here? So again, fully aligned with what you're saying, Elaine, but it's going to be quite a tricky one, because inflation has come down, but will there be a spike up on inflation? We don't expect it, but like we have to see, because one thing that it has learned me, and I'm not going to say when I graduated, because that's quite different to the years that you all mentioned, but I think we live quite in unprecedented, uncertain times, and we've seen quite a lot of different movements. So coming back to what I said in the beginning, look at the trends and try to see what is the noise around it, I think is my biggest advice throughout this current cycle.
Doug, do you have any feedback on that?
I was just looking at our questions. Yeah, my feedback would be that sometimes you think you know more than you do. And I'll give a specific example. I sit on an investment committee for a large industrial investor in the US, and that's been a great place to sit. That's where, you know, they refuse to use debt. And for years, you know, it was basically impossible to buy anything because people were buying the best warehouses with 80% loans, and you just couldn't even compete. Well, the last 2 years, we've been buying everything that comes on the market because there's no other bidders. We haven't bought everything. We get to pick what we want to buy. But I will say, in terms of climate risk and things, we had a deal that was in the northwest corner of the San Fernando Valley. It had high fire. The stuff came back and said, oh, it's got moderate to high fire risk. I said, that's ridiculous. It's a mile in from the hills. How could you have how could it be at risk? Well, boy, am I hoping that didn't get documented in the minutes of the meetings to be looked at a year. I will bring it up myself, but I hope that a year from now, heaven forbid that there's another fire there. But if that warehouse had been 20 miles further southeast, it would have blown right through it, right? So this climate risk stuff and what it means is a really big deal. And I think it's but this expense creep problem is one of the reasons I think industrial has risen and logistics has risen to the top of the pile for investors. Because it's the one place, if you have long leases and credit tenants, we just bought one for the Amazon with 15 years out in Phoenix. And I wonder about climate stuff and everything else for a 1.5 million square foot warehouse west of Phoenix. But I got Amazon on it for 15 years. We're going to be out of it. We're a long-term investor, but we're going to be out of it long before 15 years. So,
Josh, can I respond to one of the
Yes.
comments? I just read it. We've got a fellow tiger on there. He's being he or she is being anonymous, but that's okay. So and whoever it is correct. A lot of our comments, and we should remind everybody that, or we should broaden what we're talking about, because most of us are from on the institutional side of real estate. We have been talking more about investment and not development, and development is way, way riskier than investment, and investment is super risky right now. So agreed, smart money goes, but again, you have to still be careful. And, you can't just build and everybody will come, and you therefore, again, have to pay attention to those market conditions. And right now, in many of our markets, the development cycle is not yet there. Now, that doesn't mean it's not coming. And again, depending on where you are, it actually is potentially there. So I agree with whoever made that comment that most of our comments to date have been focused more on institutional side. But again, you need money to develop, and typically you're going to be taking loans out, and it's hard to develop with the interest rates potentially.
Well, Elaine, I think, it's interesting on the development side. I think it's a great point. And if you're able to execute and get something out of the ground, you'll probably get rewarded out, because a lot of things will not get out of the ground. In fact, even some recent discussions, even things like affordable housing where there's sort of infinite demand, like, it doesn't, even within any reasonable, affordable definition, it's probably going to get like 100% leased, as fast as practical. Those projects, interest rates are just completely sort of sending asunder. At least that's been the discussion I've had with developers recently. I mean, obviously different markets, different locales will have a different thing. This is not meant to be broad brush, but I will say, if you're able to figure it out, and you're able to bring in more equity to close the gap, it's probably a very good time. Now, obviously, exit cap, I don't know what I would have a hard time giving you. Like, I'm not going to definitively tell you, yeah, you should forecast a 4-cap exit on some apartment deal or something that I know people, because I wouldn't do it. But I will say that I think having some risk-taking ability to realize that if you're going to be a long-term mindset, probably a great time. And I've actually heard some pretty good feedback about construction costs. starting to come back to some, they're not going up. It's like I think a lot of the contractors and suppliers are getting wait a minute, that project we thought we were going to be on isn't going to be on. So the subs in certain markets, I've heard to hear that no, we're actually getting some competitive bidding once more. I'm not going to say it's everywhere. That's not everywhere, but I think developers, if you figure out the solution, I used to look. When I worked for Skanska, we built everything all equity, and it actually, some of the most successful deals in their sort of career history of being developers, in addition to being contractors, came from being able to launch projects in tough tough capital market cycles. Now, granted, they had to have cash to do it, and they did, but it's a good strategy to execute. I definitely think that if there's anything our industry could probably be better at, is not being so debt driven. I think it puts us into higher risk tolerance zones we probably need to be. And that's a little bit of a philosophical question, but I know we got maybe just time before we're gonna move to Q&A soon here. So I'm gonna go maybe round robin and let each person kind of opine and kind of give me your optimistic case for 2025, and then also what's the one nightmarish thing that keeps you up the most. So we'll start with Doug, then go Dennis, then Elaine.
I'm not big on optimism for 2025. I will say that I think that I think that the cost of development will come down because there's going to be a lot less development because of these things that are going on. So you want, to me, a developer who can be contrarian, the all equity developer, by definition, when there's plenty of money of debt flowing to developers, you're then following the herd if you develop with it. And when there's no debt flowing, there's no leverage flowing to developers, you're being a contrarian if you go ahead and develop anyways. I'm just going to throw one thing out at you. Last year, we added 2.2 million jobs in the US, 970,000 of them were in private ed and health. There was 10 times as much job growth in private education and health as there was in professional and business services. So the office market is not just about anything about work from home or anything else. There's 0.5% growth in the combined financial services and professional business services. So those sectors are large, but they're not growing. So that's my one caution.
I would say, Doug, I'm cautiously optimistic about this year. I rather approach it like the glass half full than the glass half empty this year. I do believe, and I fully agree with Elaine on, it's all about the building. The building needs to work in terms of your underwriting. So what I'm quite excited about is the additional insights that data and other non-traditional data types can give you and help to better understand investment strategies. The one thing that I'm pretty worried about, or that keeps me up on all night, is like the geopolitical tensions that we see, because we really moved in a world where we see a lot of geopolitical tensions. We've seen a lot of these elections flip, and there's a lot of unrest. So I would like to see that coming more to the back and not at the forefront of all of the discussions. But that's just what's keeping me up at night.
Mm-hmm. Elaine.
Okay, well, I'm kind of in Doug's camp too, and that I'm not super optimistic about this year. However, again, its pockets will be fine and really good. I guess I'm excited to hopefully see some of our major communities trying to get into helping bring back some of our inner cities, because I really am concerned about these major markets that a lot of us know and love, and it's just, places that really need to kind of focus in and reuse their space. There's a lot of space out there that's empty and obsolete, and it may be demolition, it may be rehab, I don't know, but I was happy to see DC, basically are saying, hey, just make us some proposals and we'll help, because they realize how essential our cities are to our, around the world. And again, we're not the only ones in the US. Lots of cities have trouble. As far as keeping me up at night, I gotta Dennis is 100% right. This whole political, geopolitical, our country, I mean, it's unknown, where we're going to be going. And uncertainty is so hard for investment because, again, we try to model out, we try to say, oh, we're going to put this money down and we're going to make this money when we get, have this investment. And we really don't know where things will be going between now and, the next couple of years. And we know things are changing, but we don't know which direction. And that's really hard for people to make decisions.
That's a good point. I'll add my answer to this one. We'll move to Q&A. So, which by the way, good, if you want to submit a question, good kind of time to do it. I think, my main optimistic case is that I think a large section of the real estate investor, owner, developer community, what I call private owners, non-institutional, are actually in a really good place to become active buyers, developers. And I'm talking about, these can be individuals, high net worth individuals, family offices, even people who do sort of syndication, who have been somewhat stopped out because the large institutions have been so pervasive and powerful. And then that even includes some smaller lending institutions that were also kind of less competitive. So there is a different source of capital that could come in, who knows local markets, who can kind of, I think can better act like local investors, which has been, I bet you a lot of the counselors have grew up in that world and have done and continue to do a lot of work in the world. So I actually think that that's a very good group that can kind of step in and maybe clean up some of the mistakes and push things forward. If there's a thing that keeps me up at night, is the state of the consumer. I think our GDP, a lot of our growth has been finance on credit cards this last year. If you look at credit card balances, and we're in a situation where I'm pretty sure this is true, although I haven't quite completed my research to tell you like 100% that like this is absolutely true compared to like maybe 06 other periods. But I don't think we've ever been where so many homeowners, where a lot of people's wealth is sort of imbibed in their home in the United States, where they really could not afford to buy their house if they needed to, or buy another house, because interest rates have gone up so much and prices have gone up because there's been no correction of any significance, and prices relative interest rate more than doubled in a home mortgage. And when, by the way, your insurance rate's gone up and probably your tax gone up, God forbid you need a new air conditioner roof or even a refrigerator going up. So if consumers start to feel some job pressure, you could have a more accelerated decline in consumer spending. And by the way, I mean, the Fed was, I'd say, trying to cause this crazy. And I mean, that's what does, as Doug gave the story, it didn't happen. We didn't have a soft landing. We've had a no landing I've heard this reference before, and it's kind of true with GDP. So here is that consumer, is that the rubber band is very tight on the consumer. And through home prices or other transmissions, there could be, if you have problems in the job market, right? So it's kind of an if and if, but it does. That's the thing that keeps me up at night when I look around in various markets.
And Josh,
John's come back on. Doug, you want to react?
Can I just jump in
Go
and say
for
that, the CPI print, shelter was up 4.6% year over year. So the rest of inflation was at 2%. Shelter alone basically brings it up almost, brings it up to the 2.8, 2.9. And that just accumulates on people.
My recycler today.
It's got to be crazy. Yeah. Go ahead. Yeah.
Just to here's a quick example. My recycler person today, I was out talking to him. He runs a tiny little business. He runs around picking up all of our trash. He told me today, in tiny little Walhalla, which is the tiny little town up the road, they're paying $1,000 a month to rent a mobile home. $1,000 a month to rent a mobile home.
This is
He bought a manufactured house 2 years ago, bought it for $70,000. It's now worth $140,000, but he can't afford to sell it and go find something else because there's nothing else to get into. So, I mean, there's a lot of people in that position. In the last 2 days alone, I've talked to, I don't know how many people, because I've had to have work done in my house. And so and everybody's bemoaning, $8,000 here, $10,000 there, $5,000. People don't have that kind of cash sitting around. So again, I'm not optimistic for this year. I'm sorry to say.
John, do you want to facilitate Q&A for us?
Sure. We got 2 questions that, if we can get some short answers to them. The first question we had was, short answers from economists. That'll do. Where do you see year 10 in 2025, 26, and 27? And I
I mean,
think what they're referring to is the discounted cash flow terminal.
I
Oh,
think, or the 10-year treasury, I think on that one.
probably 10-year treasury.
I will
Okay.
say, I
Same thing.
will, gosh, I mean, look, I think that I'm going to say this, and I think this is just economic truth. I'm not trying to be optimistic or pessimistic. I don't think you should expect major changes to the downside on a 10-year treasury until you probably have something negative happen that causes everyone to like panic buy into the 10-year bond. That typically is what happens. And unless inflation really crashes out 1.5%, if it stays in that 2.53% range, which is where it is, a 10-year at 4.5 is actually just kind of fits with term theory. So I think you would have, yeah, to that end, do I think over 25, 27, there is something, be it there probably some form of a black swan or series of events that causes investors to herd into the 10-year? Yeah, probably. I don't know when or what, but that, it doesn't seem like a crazy prediction. So that's kind of my thing. Is it's going to be event. The thing that's going to bring the 10-year down will probably be event driven.
Just in addition to that, Josh, like there's been so much written about the long-term secular trends that have been driving down, like bond yields from the early 90s. They have not really gone away. So I agree that they probably will stay higher for longer, and they won't go back to where they were. But one would expect, like, okay, if those were driving those interest rates down, like they haven't disappeared. We just are in a very uncertain time, and we have seen that COVID, and we have seen that spike from that in inflation. But 4 or 5 years from now, we might be back in that, like, I might call it like equilibrium, where those long-term secular trends might be picking up again where we're going. Again, that's just my personal view as a disclaimer, but they haven't gone away. The demographics haven't changed. The savings lot's still there. So I think there are arguments on both sides of the coin here, and I just really feel that it has been so noisy with where the 10-year is going. As I said in the beginning, it's been around 3.5. Last year, we've seen also close to 5. We're now closer to 5 again. There's just so much uncertainty, and it's so extremely difficult to forecast that 10-year. But again, like looking forward, I still think in the long run, those secular trends should play a role.
I mean, you could argue you could make a ton of money buying a 10-year treasury at these yields and then waiting for those moments when you could, like, when it falls, when it trades down. But the investors in the bond market don't seem to be doing it yet.
Yeah, but if I was
So-
a successful trader in the bond market, I probably wouldn't be joining you here. I would be at the
Wouldn't be on
beach
this call
somewhere,
right now.
enjoying
Josh,
my time.
how about this one? Please give your advice on how Trump 2.0 affects onshoring or reshoring. This may affect occupancy and vacancy in vacant industrial buildings.
Doug, you probably got the most industrial active experience. Yeah, thought on that.
Yeah, I think part of it is what's bluster versus what's actually policy. And interestingly, your concept would be that you'd probably put stuff, you'd be going to the boxes that are somewhat on our side of the border, but a lot of them are also their other purpose is exports. So if we get in a trade war, we're going to have lower imports. We're also going to have lower exports. I do think that people are catching on that the extreme long distance offshoring stuff carries risks, real risks. And it carries the risks also of the canals. We've only got 2 reasonable ways to get around the world, and we've had problems with one. We've had problems with both, a water problem in Panama and everything in the Suez. So I think that stuff is going to continue as people realize that long supply chains are a risk to their business.
Yeah, I will say, I think it'll be, whether it's truly Trump 2.0, but I think it'll be motivated in part. I do think that there'll be more companies or foreign companies to invest and move their factories here, even as a long-term hedge, or just in some of it, just an investment into the market in some ways. And I think that effect more of the foreign manufacturers especially now that factories are more automated, or the new ones are, so it's not so much of, I mean, the US has always been more the employee cost more than it was anything else. So I do think that will play out in certain sectors. At least, I don't know if it's a Trump thing, but as much as it is, I think just a long-term post-COVID thing. But I certainly could see that specific movement, like more Mercedes and BMWs being made in the US
Oh,
than out.
well, I was going to say, the car industry did it a long time ago.
They did it a while
Yeah,
while
I mean,
back,
they're all making them here because it turned out that they just couldn't deal with
easier.
it. Yeah, it was easier.
Yeah,
Easier and really cheaper because you didn't have to ship them. I
they
mean,
don't get stuck in the US.
back to urban economics 101, right? What's the
Yeah.
cost of shipping?
Guys,
And
let's try.
Doug is 100% right on our ability to, do long-term, bringing stuff in. I mean, clearly COVID has taught us all, but after that we've had even more disruptions. And so and who knows? I mean, again, what's bluster, what's not, we don't know. What we do know is things will change, and we need to at least be, as as business people, kind of trying to model it out and strategize. Well, there's a chance this is going to happen, there's a chance that's going to happen, and there's a chance Z is going to happen. What's the likelihood? And then prepare for it. Risk mitigation, once again, is going to be key.
One last parallel question to piggyback on top of that. Can the panel comment on the impacts of proposed tariffs expected from the Trump administration? Quick answers, because we got like 4 minutes left.
I would say, again, depends on if they happen. If they happen and there are tariffs, they're going to probably have an impact on inflation. It's not, that's not a rocket science thing. But anybody else?
I will say on tariffs, and this is something I don't remember who I heard this from, but I did read recently about how from the Fed's perspective, at least their interest rate reactions, tariffs are very quick, one time, like they get impacted. They're not thing that would change the Fed policy, because they're not the same thing. Now, follow-on effects of what the tariff does, and if it's reciprocal, that could obviously create a situation where the Fed reacts. But they could certainly, they're not as hard to plan. It's easier to plan around. They're not the same effect of generalized cyclical inflation. That's just the thing to know. They can be painful in different ways, or they could get absorbed. The truth is, we don't really know if if it's just like, say, 10%, that actually could totally get absorbed by the manufacturers in the other countries. I mean, for certain goods. Now, for some goods, it'll almost 100% get passed on to the consumer, the final end consumer. It's just that it's really, you got to get really tactical. And I don't think I don't know enough. I would worry about construction. We get a lot of our complex construction materials from like glass curtain wall, as far as I'm aware, is almost entirely from China, or in Europe or other places like that. I mean, I might be wrong on that, but I know it's overseas sourced a lot of times. So certain things that can't be in-sourced are more likely to just see the price increase. And that's just the common sense.
I just jump in. I'm going to take just 30 seconds and say, since our trade is close to balanced, remember that the tariff impact is going to be in both directions, because no one is going to not tariff us if we tariff them. They already did that in the last round. So if we tariff Canada, Canada is going to tariff us, and everything we ship to Canada is going to go down in demand.
Dennis?
Buy your maple syrup now.
Yeah, I just think from on the other side of the ocean, how we look at it, it's a lot of rhetoric, and I think we just need to see what's really going to be implemented, and what can be implemented by when. Will it still be happening throughout 2025, or will we see it really pushing into 2026? That's just how I look at it. Like, I just feel it's more like a negotiation position at the moment that they're trying to make than putting all these tariffs on, because I saw in the news yesterday that they also don't want to increase inflation too much, because that will also look not too good on the incoming administration, I would assume.
And we'll have to make that the last word. So thanks to Josh, Elaine, Dennis, and Doug. You each exemplify the exceptional and high-level thought leadership for which the Council of Real Estate is known. While change is certain and inevitable, its byproduct is uncertainty and risk, as we've learned today. While no one has a crystal ball, anticipating what is to come informs and guides all our decision-making, especially now as we enter a period of significant change in the geopolitical and financial arenas. As demonstrated by today's presentation, a counselor of real estate can help you enhance the clarity of your crystal ball so that you can not only effectively manage, but also prosper from the inevitable change that's coming. I'd encourage you to consider engaging a designated counselor of real estate when seasoned advice or a solution to a complex real estate matter is needed. Perhaps you might consider becoming one of us and seek invitation to membership and the CRE designation for yourself. Please join us February 27th for Crisis in Appraisal Land. You may register at CRE.org. And as a reminder to all our counselors who are attending today, please join us for SIGPalooza, February 3rd through the 10th. These 12 exclusive and interactive forums provide counselors invaluable opportunities to collaborate, exchange information, offer perspective, and pose questions to fellow CREs of similar specialty in an atmosphere of trust and cooperation. And you can register for those at CRE.org. Until next time, on behalf of the counselors of real estate, thank you for attending this session of What's Next for Real Estate and the Life Experience. Thank you all very much. Have a great day.